Hello, everybody. My name is Tim Weinkoff. I'm the Director of Program Development and Innovation within the Disabilities, Inclusion, and Accessibility Division of Community and Social Services. I'm going to be covering Module 3. And before we get into the module, I think it would be helpful for viewers to have handy the hard copy of the template. And in particular, for the first portion of this module, I'd be referring you to Schedule B, which begins on page B1 of the contract template. If we want to just take a moment right now to review that, that will consist of the initial beginning, which speaks to advance funds. And Marika had already discussed that as part of her earlier module, and that those will continue to be an option for service providers to discuss with the service delivery region as far as using advance funds, which would again be reconciled by term end. If you then were to turn the page of the template, what you're going to next see is the Schedule B. And again, in the Schedule B, I'll be covering it in the PowerPoint slides, but it is very helpful to take a look at that as we go through the slides, because it not only talks about the three large funding components, but also highlights that there are categories of funding within those components. And that's going to be helpful for you to know, in particular, when we go through the presentation pertaining to reallocation and the clauses around 611. So again, please review Schedule B, in particular, with the three large funding components and then the categories. It's also going to be helpful for you to then review the eligible operating and capital expenditures. Those are following Schedule B in the contract template. I'll be going over some of the highlights, but again, it'll be content that you'll want to become very familiar with as you consider how to use your funding to best meet your needs. There is eligible operating, eligible capital, eligible ancillary program costs, and then there are ineligible expenses. All of those items are listed on the pages following Schedule B. Finally, I think for review purposes, I'll make reference to it later on, but again, you'll want to then take a look at Schedule C, which is the invoicing form, Schedule B, which is a referral confirmation, and then at the very end of the agreement is the financial reporting template, which I'll cover a little bit later on. Those are the main sort of parts of the contract template, which I want you to pay attention to as we cover this module and as you consider your options going forward. So if you could reference Schedule B, what you will see is that the contract funding is broken into three distinct components. We have the direct service costs, which pertain specifically to frontline staffing costs, the indirect service costs, which are the supervisory costs, administrative staff costs, and the eligible expenditures, which I'll be providing more detail about later, and the ancillary program costs. In sum, these three funding components make up the total contract funding. And as you can see by the slide, generally, the direct service costs, those are the ones tied directly to the referral forms, are going to be larger than the sum of the APC and indirect service costs, as has been historically the practice. If we were to do a comparison in a transition from last year to this current agreement, what we could say is that in the 2016-17 services template for PDD, we have three funding components: direct service costs, service delivery, and administrative expenditure. From a transition perspective, we can see is that going into the 17-18 contract template, we'll continue to have direct service costs, and again, those are pertaining to the aggregate amounts on the individual referral forms. And instead of service delivery and admin, we will now have what's referred to as indirect service costs and the ancillary program costs. again, which I'll provide more detail in a few slides. So let's begin with direct service costs. As I said earlier, this portion of the funding is specifically tied to the services to the individuals under the agreement. And as you will see in your Schedule B, the total amount there reflects the maximum funding available under the contract for the provision of those services to individuals, and again, which are payable or linked directly to the individual referral confirmations. So let's take a look at an example. So as a visual, and as we think about going into this new contract template, the sum of the anticipated referral confirmations for the contractor and the contract, that becomes the projected total for the total direct service costs. And that is going to be the amount set out in the service request sent to their qualified service providers from the service delivery region. And as had alluded to earlier, if you are entering into a 3-year agreement, that anticipated referral confirmation sum will be for the 3 years of the agreement. Whatever that funding amount is that's identified in the service request will be, for direct services, will be the basis for Category 1. As an example, we can see is that in this instance, we have a number of anticipated referral confirmations over the term of the agreement. And for example purposes, they add up to $300,000. And that would be identified in the service request and again become the funding that would be targeted towards Category 1, which are those frontline staffing costs. Now, as is the case right now, in addition to direct client services, contractor will receive funding that is related to the provision of those services. We think of them right now as indirect service cost and ancillary program costs. And they are going to be a lump sum payment that is reflective of the initial total service costs. And that lump sum payment will be identified in the service request, and it is to be allocated by the service provider across the indirect service costs and ancillary program costs. Now, an estimate of that for the 3-year period will be set out in the service request. The actual amount that's ended up in the contract may vary from the service request, and that's going to be a function of discussions and negotiations after the service request is responded to. But as we have historically done, along with, if we think of current practice, along with direct costs, you get service delivery and administration funding. Now you'll get direct costs and indirect service costs and ancillary program cost funding. And I'll provide further example here. So in this slide, really, it's just a visual to say is that there are the total direct service costs, which we identified earlier, and that you will be provided with indirect service costs and ancillary program costs. As we go through the example, it will be up to the service providers to determine how that funding is to be applied across those 2 categories in Schedule B. For example purposes only, we identified that in the service request, for total direct service costs, it was $300,000. And we're going to use, so we're able to do some maths with our examples. For the indirect service costs, it's $30,000. APC, it's $6,000 for a total contracting of $336,000. Now again, we're going to find out that while that might be an initial starting point, there is going to be the ability to reallocate funds across those various funding categories to respond to changing need. So indirect costs, we'll just reiterate, those are in addition to the direct client services, you are receiving funding for the indirect service costs. Now let's focus just on the indirect service costs. Now, what we see here is that if you take a look at Schedule B, again, from an indirect service cost, these are going to be categories 2, 3, and 4. Supervisory costs, administrative staff. And in relation to categories 1, 2, 3, which really speak to staffing, as I identified in Schedule B, there are guidelines to facilitate determining which category would now fall under either frontline, supervisory, and administrative staff. It would be helpful to take a look at those guidelines, and I'd like to reinforce that these are high-level descriptors, and they may not accurately describe the frontline, supervisory, or administrative staff functions for your organization. However, what they just want to do is provide you with some guidance about how might you allocate funding for those staffing costs across those 3 areas. It also acknowledges that there are some staff who assume roles in more than one category, and as somebody considering how to use the indirect funding, you would want to think about, where do I put funding for my supervisory or administrative staff costs as part of that indirect service cost funding that you provided. The category 4, which are the expenditures, again, that's captured under Schedule B as a category 4. And with the indirect funding, you're going to, or with that indirect and APC funding, you're going to identify what would be the funding amounts that I want to put in categories 2, 3, and 4. And this is as a beginning point, and this is to begin the contract term. And again, there's the ability to move funding within the various categories to respond to need throughout the term of the agreement, which I'll talk about a little later on. So that's categories 2, 3, and 4. It would be very helpful for you to become familiar with the eligible operating expenditures. And in Section 3 of Schedule B, which follows the Schedule B, we provide greater clarity on what is and what wouldn't be considered an eligible operating expenditure, and also contracting expenditure. And I think it's important to note, and this is at the beginning of this particular section, that the list is not exhaustive, that you may find that there are expenditures that you are experiencing or finding a need for that aren't identified in this particular table, or the table on capital, or the table on ancillary program costs. And that when you find such a situation, to talk to your service delivery region to identify that need and have a conversation about its inclusion as an eligible expenditure. Another, as you can see, is another thing that we want to reiterate is that when you have funding from more than one source, and that funding is to be applied to one of these eligible operating expenditures from both of those sources, it should be thought of as proportionately. And I'll use just audit or review as one example. If there is, you find that there is a need in your organization to apply funding under this agreement for audit or review, and you also receive funding from another contracting source that will also require audit or review services, and you are going to bear those costs equally, that you would apply or expense 50% of the cost for audit or review that's under this agreement, and 50% for those services under the other agreement that you're receiving funding to. There may be different scenarios that are going to unfold as you consider this, but the intent is just simply for you to consider being proportionate as far as how you're going to allocate or expense against these line items if you have more than one source of funding. If you have only one source of funding, and that might be this PDD contract template, then really you're going to be expensing the funding, all of the funding for that line item under this agreement. Now, there are a number of items under the eligible operating expenditure line items. And as I said earlier, it's going to be very important for you to go through all of them and become familiar so that you can make a good informed decision about which are those line items that you want to provide or allocate funding towards or expense your funding towards. And so I'm just going to go over a few of them that are of note. One is that we all know that the use of technology for the provision of services can be sort of a very helpful tool in supporting individuals. And so we now have identified that information technology under $1,000 is not considered a capital expenditure, as it may have historically been done, but can be complained as an eligible operating expenditure. And that might include such things as laptops, phones, and other small IT purchases. Another highlight is that there are some items, including IT expenditures over $1,000, where amortization or depreciation is added for those assets that support direct services, but are also required for the indirect support of the organization. And you'll see that in those cases where it's the outright purchase of those expenses will not be permitted. And that would be, as an example, again, I'll refer to IT purchases over $1,000. However, that expense can be amortized over the useful life of that asset. And you'll also see, is in that particular description, that licensing fees, maintenance fees are also part of that and can be expensed as an operating expenditure. The third point here is that there are a number of items which may not have a sort of a clear definition, but are nonetheless eligible operating expenditures. And these are going to be items that are really covered under the other overhead costs element that is part of that table. When it comes to considering what might be provided under there, again, I think it would be helpful for you to have a conversation with your service delivery region if appropriate, but that is a category where we wanted to provide some flexibility to include some things that aren't already identified under the expenditure line items here, and give some flexibility to service providers to put items in there. And again, another one is that, from a capital perspective or from an operating expenditure perspective, rent, lease, or mortgage interest costs, if they are approved by the province and that they are directly related to the provision of services, can be an eligible operating expenditure. And that is because we, as far as needing approval, because it is capital, the province needs to ensure that the funding applied to that particular item really directly relates to the provision of services under the agreement. And you can see as when it comes to offices, some of the facilities or buildings where people are living, and they're directly tied to the services under the agreement, you're going to be able to apply the interest costs around rent, lease, or mortgage to that. And again, as we're not able to cover all of the items under this presentation, so please take a look at those expenditures, become familiar with them. If you have questions, talk to the service delivery region staff, as well as we'll have a question and answer document that may address some of the questions you have as well. So as you move through that particular portion of Schedule B, you'll see the next areas around eligible capital expenditures. And for reference point, capital assets from a government perspective are typically not paid outright, but are amortized or depreciated as a capital operating expense. And so again, that's where you want to go back to eligible capital operating expenses and the area around amortization and depreciation. And again, that whatever that amount is, it can only be claimed for the term of the contract. And that is if you have an amortization schedule of 10 years and the agreement is for 3, you're going to be able to expense for the 3 years of those 10. And as Marika had said earlier, if you're going into a new contract the following term, then you would be able to apply the next 3 years to that following agreement. And again, from sort of a contextual piece, really amortization speaks to the idea of a fixed repayment schedule in regular installments over their period of time. And again, the guideline is really over that asset's useful life. What that asset's useful life is going to change depending upon that asset. I guess you would be in discussion again with your financial folks as far as what that might be. And from us, as far as capital expenditures, we do want to ensure that the proposed expenditures from an amortization or depreciation perspective are, again, directly tied to services and are going to support the indirect costs of the organization in providing those services. As you can see in the schedule, there are 2 exceptions, and that is office equipment and furnishings and upgrades to physical infrastructure. And with regards to the upgrades to physical infrastructure, once again, because it is capital, that's going to be approved by the province. And so you'll have to have a discussion with your service delivery region staff as far as that particular approach. And as the contract says, is that approval won't be unreasonably withheld. The important thing here, which Marika led in earlier, is that it's going to be important that service providers and the service delivery staff continue to have regular conversations, continue to have a good working relationship as far as moving forward on services under this agreement and any related expenditures. So take a look at those capital expenditures, and please note that at the bottom it notes that you cannot both purchase capital expenditures and also amortize at the same time. It would be one or the other. The third large funding component, and that is again category 5, is the ancillary program costs. And as this slide says, is it's targeted towards the organization, and it's not linearly or directly connected to the provision of direct services, but they are nonetheless costs that the service provider needs to incur in order to carry out and operate that program. And so we've acknowledged that there are a number of areas here that may indirectly relate to the provision of services, but are a need nonetheless. And again, I'll reinforce that the list is not exhaustive, and if you're able to come up with some other items that are you believe are necessary to include in this particular funding component, please talk to your service delivery region. So let's take a look at these. And again, these are provided as a part of the lump sum that's representative of the total direct service costs. And again, there may be some variances that are either in direct or indirect service costs that can be reallocated to the APC. And again, there's certain rules around reallocation into APC, and that one of them requiring approval of the service delivery region, just given the nature of this funding. And I'll provide some examples of that. So as you can see, if you're following along in your contract template, there is a listing of the eligible ancillary program costs. And this slide reinforces that where there are some that are not yet identified, to talk to your service delivery region about consideration for them to be eligible. It's also important to note that we had a lot of good discussion in the negotiation, and that there are a number of items here that weren't initially on the table, but we acknowledge that they do indeed support the organization. And so after a good conversation, we were happy to consider inclusion of them into this particular funding category. Further, there are some expenses which are just ineligible. They will not be allowed to be expensed against or expended under this agreement. If you believe that they are necessary expenses for you to do your business, funding would have to come from someplace other than this agreement. And again, it's going to be important for you to take consideration of these ineligible expenses. Of note, there are some of them, I'll just highlight capital purchases, where the purchase of capital or the acquisition is ineligible, but it also then says is please refer to eligible operating expenses, depreciation expense, information technology 1,000 and greater. This also is referred to under new major physical infrastructure. And that is, again, to go back to as well, there may be there is the inability for outright purchase of these types of expenses. There is the provision for amortization and depreciation against them. Please refer to the eligible operating and capital expenditure items. And where you have questions, please contact your service delivery region staff to see what you can sort out. What I do want to clarify is that when service providers are populating their Schedule B and considering how they may want to apply funding towards the various line items under the eligible expenditures, it is not necessary for service providers in the Schedule B to identify those specific line items. Rather, all they will be doing is identifying a lump sum amount in each of those areas in Schedule B that they are anticipating will be used towards that area. There is, again, no need for service providers to, in a Schedule B, identify specific line items in any anticipated allocation. As I will talk later, there will be reporting on that on an annual basis, and that's where that will come into play. But from a Schedule B perspective, please consider just the funding for those 5 categories from large amounts, not line amounts.
We have a question.
Yeah, this is Cora.
We're now going to cover the portion of the agreement that speaks to reallocation of funding. And for reference sake, I would suggest that you take your template and go to section 611 for reference purposes. In 2016-17 PDD contract template, we can see those 3 large funding components: direct service costs, service delivery expenditures, and administration expenditures. This agreement allowed the ability to reallocate to and from those funding categories with no approval and no limits. In the 2017-18 template going forward, we still acknowledge that there's going to be the need for service providers to consider reallocating funding, and there's going to be some defined ability to reallocate, and some particular reallocations are going to be with provincial approval. And this is where Clause 611 comes into play. Now, that clause in particular acknowledges, again, the flexibility to move money from certain categories without approval, as long as the amount doesn't exceed a certain threshold. And then there are certain categories, in particular reallocation of capital expenditures and reallocation into APC, which require approval of the service delivery region. And again, is considering that allocation and it makes sense and it supports the operations of the organization in support of services under the agreement, that reallocation should not be unreasonably withheld. So, in the course of a term, the contractor, as you recall, they started out with a particular funding amount set out in Schedule B around those large funding components and then within the specific categories. it may come to a point in time where the budgeted amount for that particular category doesn't match the actual need. And we talk about this is that amount might be either overstated or understated in relation to the actual need. Overstatements are where the funding that was originally considered needed is more than what is actually needed. Understated is where, conversely, it's less than what is needed. And there is ability to move, as an example, between overstated and understated elements in order to address those needs. We talk about this from the perspective of positive and negative variances. These variances can be addressed through reallocation as outlined in Clause 611 in the contract. So let's just walk through an example. We know that we had $300,000 towards the direct services. Those were tied to the individual referral confirmations. That was set out as part of the initial service request and then became a component of Schedule B. We further know is that there was a lump sum payment of $36,000 provided to the provider for indirect service costs and APC. That service provider then said I'm going to apply $30,000 towards indirect and $6,000 towards APC. And as this slide suggests, $30,000 was broken down into categories 2, 3, 4, and in particular when it got to 4, it was really around eligible operating and capital expenditures. And that once again, as you can see, is that when it comes to those expenditures, there's no accounting on a line-by-line item. Rather, they are addressed sort of at that aggregate funding amount that the service provider initially budgeted. Similarly, when you take a look at the $6,000 for APC, it's a total dollar amount that the service provider is considering to apply to expenditures under that particular funding component. Now, in the event that there are variances, either positive or negative during the term, the contractor can reallocate funds between categories 1, 2, 3, and 4 without approval, as long as that approval doesn't exceed 20% of the initial originating category. And as you can see in that first bullet as well, there are restrictions around capital, which I will discuss later. But the general rule here is 1, 2, 3, and 4 can be allocated as long as you do not exceed 20% of the originating category. So in this example, we say as well, we remember that there was $300,000 in the direct services. 20% of that $300,000 would be $60,000. But in this case, the service provider has identified an overstatement in category 1 and wishes to reallocate that elsewhere to address needs. So the service provider then takes that $10,000 and in this particular scenario identifies a need to put in additional $2,000 into category 2, which is supervisory costs, category 3, which is the administrative staff, another $6,000 there, and then $2,000 added into the operating expenditures. Once again, I'll reinforce that those are lump sum dollar amounts. They are not tied to particular line items. Now, given that that is below the $10,000 threshold, the 20% threshold, there is no approval, but there will be, as you'll see, the need to provide an updated Schedule B to the service delivery region. Now, if we take a look at reallocation of capital expenditures, which is 611D, if the contractor wishes to reallocate funds either to or from category 4 eligible capital expenditures, then those have to be approved by the service delivery region. And again, as we think back to an earlier slide, given that capital expenditures play a particular role from the perspective of government policy and practice, service delivery regions must approve those reallocations. Again, not to be unreasonably withheld. And as that second bullet talks about, is that type of reallocation needs to be approved because if, in particular, if it's going into eligible capital assets, the province needs to ensure that those assets are addressing the needs of services under the agreement. And again, if the contractor wishes to reallocate positive variances towards eligible operating expenditures, and in particular, when it comes to amortization and depreciation for an asset, then that should be done, that needs to be done with the approval of the province. Then there is reallocation into the APC. So if during the contract term there's identified a positive variance from 1, 2, 3, or 4, and the contractor wishes to allocate that into Category 5, or which is the APC, then approval of the service delivery should be sought. And again, is because of the nature of APC that those services or those costs are not directly tied to the provision of services under the agreement. The region and the contractor should have a good understanding of the need, have a discussion, and to understand what is going to be occurring, and approval sought. And again, is when it comes into reallocations into APC, that can happen at any time during the term of the agreement, whether that be a 1, 2, or 3-year term, or within 90 days after the contract expires or is terminated. In particular, from an expiry perspective, what we acknowledge is that at that point in time, at the end of the term, the service provider may need some time to work with his accountant and financial services to understand the true financial nature of funding under this agreement, and at that point may be able to reallocate into APC. Again, the issue of reallocations and reconciling against them will be addressed when we talk about the surplus. So, in the example we had, the contractor had an initial budget of $6,000 towards APC, and there is provision to exceed that allocation. And that is when you take a look at the agreement itself, it talks about a 20% threshold. However, if there is a desire for a service provider to reallocate for an amount greater than that, they can enter into a discussion with the province and may be provided approval to make that type of allocation. I think it's also, we need to acknowledge that where reallocations are greater than the 20%, the region may be having to understand better why we have that type of large reallocation, why we have that type of positive variance. As an example, if there is a desire to reallocate 40% from direct services into maybe categories 4 or 5, there may be some discussion about whether individual referral forms need to be adjusted, since we're seeing that type of positive variance. I'm not suggesting that would be the case, but of course, any allocations above those thresholds will trigger a conversation between the service provider and the service delivery region, and approval is needed. And again, reallocations, when you think about it, will result in changes to Schedule B, where you make an adjustment in one area that's generally reflected in increases in other areas. And so as you can see at the bottom of this slide, where funds are reallocated between categories, contractors to provide an updated Schedule B to reallocate that up to reflect that reallocation. If there are more than one reallocation occurs in a quarter, we are suggesting that only one updated Schedule B be provided at the end of that quarter versus multiple updated Schedule Bs. If there are only 3 reallocations through the term of the agreement, then only 3 updated Schedule Bs would be provided to the service delivery region. And if there are no reallocations throughout the term of the agreement, there is no need to submit an updated Schedule B. What was the starting point will be what's kept on file and acknowledged as the Schedule B for that term. Again, it's just a matter of ensuring that the service delivery region understands how funding is being reallocated, and that the rules that are set out in the contract are being applied. As the second bullet says, reallocations aren't the only way to adjust the contract budget. That might be a matter of there are more individuals coming into services, and so direct services are increased. That increases Category 1. There may be a need to address indirect and APC. There's going to be a lot of different circumstances over a 3-year term that may need adjustment of Schedule B that aren't necessarily a mechanism of reallocation. Pause, please. This next slide speaks to financial reporting, and as you can see, there are 2 types of reporting in this agreement: financial and programs and outcomes reporting. We will cover program and outcomes reporting in Module 4. I'd like to now focus on financial reporting, and if you could please refer to Articles 7.1, 2, 3. You'll also want to become familiar with Schedule C and Schedule D and Appendix 1 to Schedule D. I'll go over these. There is financial reporting annually, and as the agreement says in Article 7.2, on an annual basis, and it's within 90 days of the contractor's fiscal year end, the contractor must provide its latest annual consolidated financial statement, And if those consolidated financial statements are audited, the contractor will provide the region with a copy of that auditor's report. This is consistent with current practice. Now, also annually, and this is where you would want to refer to Appendix 1 of Schedule D, which is at the very end of your template document, there is the financial reporting form. And if you take a look at the financial reporting form, really this is a document that will be providing to service providers electronically for ease of use. And there are areas in that particular reporting template where the contractor will identify what was the initial budget, what was actually spent relative to that, and what was the variance. I also want to point you to pages 2 and 3 of this particular reporting template. And just note that when it comes to categories 4 and 5, there isn't the need for service providers to identify what was the budgeted amount that they initially allocated towards that one or more particular line items, rather only what was the actual expenditure for that particular year for that line item. These will be provided, as I said, on an annual basis. A question has come up about where a service provider has audited annual consolidated financial statements and the provision of an audit statement at the end of the term. We will not address that right now in this presentation, but we'll ask that you refer to the question and answer document that's made available on our website. In the agreement, there's also the ability for financial reporting on request. As you can see in Article 7.3, is on the request of the service delivery region, contractor would provide an independently audited financial statement or auditor's report at any time. Now, the trigger for this might be any number of reasons, including the ministry's need to do random sample audits on contracts that it administers as more of a quality assurance perspective. It may mean that there is a need to take a look at in-year financial considerations that the region has had discussions with you. But as well as we also, as alluded to earlier, we acknowledge that this is an area where we'll build in some policy and process around what might constitute the need for an audit on request. In particular, when it comes to such a situation, the province will pay the cost of that requested audit up to the maximum amount that's agreed between the province and the contractor. So the contractor itself will not bear any cost for the cost of that audit. Financial reporting, and that's either on expiry or termination. We've talked about termination being a very extreme situation. It's more likely that it will be on expiry. The clause speaks to the need to provide within 90 days after the expiry of the contract auditor's report. I will restate once again, if there are 3 years of audited consolidated financial statements, we'll address that particular scenario in the question and answer document. Also, there's been questions about whether if there's the ability to negotiate a time frame other than 90 days for the submission of that auditor's report. And if there is provision under the agreement in clause 25.4 to waive such a requirement and agree upon something other. And again, that will be addressed in the question and answer document. But that's financial reporting on expiry or termination. There's also another type of financial reporting, and that's on the invoicing. And if you take a look at your template document, there's Schedule C, which speaks to the monthly invoices. And these are to be submitted within 25 days at the end of the month following the provision of services. And the intent is that the province, as always, will pay the contractor as soon as possible, not to exceed 15 days of receipt of that approved invoice. If the invoice is not approved, the province will provide the contractor with its reasons within 5 business days of receipt. And that will allow the contractor to correct that invoice and submit a new one so that payment is not withheld. As has always been the case, service providers are to invoice on a monthly basis based upon the current active referral forms. And if you have any questions about the payment process for your particular service delivery region, please talk to the staff, and I'm sure they'll be able to talk to you about what is the practice as far as monthly invoicing and relative to this agreement. Surplus. This is an area that Marika had identified earlier that we would speak to, and that has garnered some attention. And what we just want to highlight is that under the Financial Administration Act, government is only allowed to pay for services, goods or services, if they've been received or delivered. Now, in the case of the PDD service delivery model, we acknowledge that there's the need to have some flexibility to move beyond this. Advance payments is one consideration where we acknowledge that there's need to provide funding to service providers for operational cash flow at the beginning of the term, but that's again reconciled by term end. We also acknowledge that the provision of monthly invoices, and in some cases those are based on a set monthly amount, reflect that it's a consistent amount when in fact there may be ebb and flow in the delivery of services. But again, acknowledging that from a service delivery perspective, we have to take that into consideration. And so what we do know, though, is at the end of the term, the total amount provided by the province is to be reconciled against the actual expenditures and services provided by the contractor. And here's where I think it would be important to go to the definitions that are in the term or in the agreement template itself. And that when it speaks to the issue of surplus, it speaks to services and expenditures provided under the agreement. And when you take a look at services, it speaks to those things that are delivered as set out in Schedule A. And if you go to expenditures, it speaks to those things that are identified in Schedule B, which again are the categories 1 through 5. Now, where the total amount provided by the province exceeds the total amount expended for services, expended or expensed for services and expenditures that could be considered surplus and may be returned to the province upon request. There's going to be lots of different scenarios that are going to unfold. And again, is that you'll have to consider in relation to surplus, by the term end or 90 days thereafter, have all of the funding that's provided and that's been allocated towards categories 1, 2, 3, 4, and 5, either being expensed or expended. And as the example where we talk about in ineligible expenditures, when it comes to funding that is in a contingency fund or reserve, and it has not been expended or expensed prior to term end, that could be considered surplus. So really what this visual here tries to say is that if at the end of the contract, the services provider and the expenditures expensed or expended through the term equal the payments provided by the province through the term, then no surplus exists, and all funds have been attributed to the services performed under the agreement and expenditures identified. Where you have a situation where the services provided and the expenditures through the term do not equal the payments, in fact that the payments were more than that what was provided or expended, then that may be considered a surplus. And we have the decision around the return of surplus is going to be made through a conversation between the service provider and the service delivery region. Just for further clarity, and again, what's really going to be important when it comes to the discussion around surplus is that the service provider and service delivery region staff have some good in-depth discussions about this. As an example, it's been brought up that vacation accrual, that becomes a liability. It is incurred during the term of the agreement, but in many cases is carried forward. That would likely be a situation where that would not be considered a surplus. Another area might be is where there are security or damage deposits that are part of a rental or lease agreement. Again, we would be recommending that those not be considered surplus for the purposes of this agreement. And there's going to be lots of different scenarios under this contract where it's going to just require folks to have good discussions. So as this slide says, is after expiry of the contract, if a surplus is determined, the contractor will, upon request, return a surplus to the province, and that's covered under Article 6.5. We want to clarify that in moving to multi-year terms, that means that surplus is only considered after the term end. During the term, within the term of that agreement, what we talked about is annual positive variances. They can be reallocated to other budget categories, and they are not considered surplus. And of course, in those reallocations, you're going to have to pay attention to the reallocation rules that are provided in Clause 611. And really, that last bullet on this particular side talks about that there may be a need throughout the term of the agreement. It's not unusual for new folks to come into service. And in circumstances where funding from the referral confirmations increases or decreases, the number of people change or associated services for individuals change and they require an adjustment, referral confirmations may need to be amended. That's consistent with current practice And again, what would happen is that all that would happen is you would amend Schedule B. What you'd have to be cognizant of is where the service, let's say the total funding for new services exceeds the original contract value set out, that what would have to happen is an amendment to the contract to reflect that new funding amount. This visual just really talks about, at a glance, the various topics that we've covered in this module. And it really talks about up at 11 o'clock from a clock perspective. The service request that was sent out, it's accepted by the qualified service provider, and through some discussion and negotiation, a services agreement is signed. It may be that the service provider requests advance funds, and those are provided at the initial term of the agreement, and as I said earlier, reconciled at the term end. And the contractor begins to provide services to the individuals under that agreement. And down now at about 4 o'clock, services are continuing to be provided throughout the term, and the province pays monthly installments based on those approved invoices. And throughout the term, as we talked about annually, there's going to be the submission of the consolidated financial statements, and if they're audited, the report to a company, as well as the financial reporting template set out in Schedule 1 to Appendix 1 to Schedule D. There may also be, if we look at 7 o'clock, there may be the need for reallocations throughout the term, and again, is the service provider is going to be paying attention to the reallocation rules. There may be times where they're going to enter into discussion about approval for reallocations, and nonetheless, anytime there are reallocations, they're going to be submitting an updated Schedule B. And then we get to the term end, and we have an auditor's report that really talks about what was actually expensed or expended towards services and expenditures. And if it gets to a point where there is surplus, where the surplus exists, where the costs do not match the total funding, there's going to be a discussion about how to address that, those surplus dollars, and that can result in any number of different scenarios. And then in all likelihood, that 3-year cycle, if you're going into a 3-year agreement, is going to continue as this visual says. We're now going to move on to Module 4, Outcomes Performance Reporting. And for this particular module, I would suggest that you refer to Section C of Schedule D, titled Outcomes Performance Reporting. In this particular section, it provides some description about the approach that I'm about to describe and how we will continue to report on outcomes that we're achieving on behalf of the individuals that we support. Before I do begin, though, I do want to acknowledge that what you see in the Section C of the contract is the result of a collaborative approach between PDD-funded service providers and PDD regional staff. That collaboration came about as a role of the PDD Provincial Contract Advisory Committee. When the program, in support of with the sector, moved towards outcome-based service delivery, it was acknowledged that we needed to find some mechanism by which to see if we are indeed achieving outcomes on behalf of individuals. In the current 16-17 PDD service provider template, you have what was the initial PDD performance management framework. And that particular document used a quality of life construct as the framework for aligning particular goals that were to be met by service providers. In that particular version, there were mandatory measures and non-mandatory measures, and it also provided the opportunity for service providers, to identify measures not already populated within that template and to report on them. It was acknowledged at the outset that this particular version was a beginning point, and that the PDD, Provincial Contract Advisory Committee, would take on the responsibility of monitoring its implementation, evaluating how it's being used by service providers, and considering whether there were any improvements or enhancements to what we were currently doing going into the next version. That PDD Contract Advisory Committee did just that over the last year and spent a considerable amount of time focusing in on what you see in front of you, which is version 2 of the Performance Management Framework. You will see that it continues to use the quality of life construct as the framework by which to align individual goals. However, we've taken on a different approach to how those goals are identified, and I'll talk about as well as how they're going to be reported on. But I do want to acknowledge the fine work of that committee in coming up with what is a sort of a newer version, newer approach. Again, if you just want to take a look at Section C, the very first area that it covers relates to both the identification, measurement, and reporting of individual goals. The quality of life, as I said, construct continues to be the framework by which to do that. And what is going to be different going forward is that goals set out in the individual service plan are going to become the mechanism by which we understand, evaluate, and report on the achievement of outcomes. And that is that prior to services beginning, if we have a new person coming into an organization, prior to those supports beginning, the individual, their family, their support network, and a sort of a collection of others meet around the development of the individual service plan, along with sort of specific strategies that are going to help to, support the individual to achieve those good outcomes, are very individualized outcome goals. And these outcome goals, as we all know, are generated largely from the desires and wishes of the individual and their family/guardian about what they want to achieve in the upcoming year. Because, as we know, individual service plans are generally revisited, evaluated on an annual basis, and set the stage then for provision of services and perhaps enhancements to the ISP going into the next year. What this visual really speaks to is that whole process whereby through the development of the individual service plan, there is the identification of individual goals. And as per provincial policy, those goals are aligned with the quality of life outcome domains. And as you take a look at the Section C to Schedule D, you can see that there remain to be the pillars and domains related to the personal outcomes construct or quality of life construct. When we think about aligning the goals with those outcome domains as part of the ISP process, what we're acknowledging is that there will be some discussion. There is no intent through this process for service providers to identify what the goals are, rather than where the goals are relative to these outcome domains and how many there may be within one or across those outcome domains. As the visual says, then really the folks begin to implement all of the sort of strategies and activities that comprise the individual service plan. And as number 4 on this visual suggests, by the end of the year, there's a meeting to evaluate the achievement of those outcome goals. Then what we're going to be talking about, and I'll explain in a bit more detail, is that there'll be reporting on the quarterly level for how outcomes are met or not met relative to those individuals that the service provider met with during that quarter. At the end of 4 quarters, we would have the results of 1 year, We would be rolling that up at the aggregate level, that is not by the individual level. We'd be rolling that up by agency for all the individuals it supported. And we're going to be able to see how we did relative to meeting or not meeting those goals and what were the rationale. So if you want to just quickly refer back to Section C and that first part that relates to individual outcomes. Again, there's going to be the provision of an electronic reporting template. And on this reporting template will be the ability for the agency to provide some generic information about who they are, when this submission was made, what period of time the results relate to, that is, what quarter of the year, or what is the time frame. It might be from April through to the end of June 2018 as an example. And then there will be an area where service providers will be able to input individual names, and the spreadsheet will also be able to accommodate if you have individual A and they have 5 goals, the sheet will be able to accommodate where those goals reside, that is, in what particular domains of the quality of life construct, and simply how many goals might be within one or more of those domains. The spreadsheet, as soon as the service provider inputs that there's a goal in one domain, it will pre-populate an area that identifies that a goal was set. And as I said, if there are 5 goals for the individual across a number of domains, it will be able to identify where those goals reside, what domains, and then aggregate for the individual how many goals were set. And this will be done on an individual by individual basis. And the reporting template will then also be able to preload, based on what's input at the individual level, how many goals were set, how many goals were met. And you're going to see that there's also going to be the provision in this reporting template for where goals were not met, what were some of the reasons that they were not met. And in this spreadsheet is going to be the ability to use a drop-down menu to identify a series of pre-populated reasons where those goals aren't met. There will also be the provision to identify if there is a reason that the goal was not met other than what's identified in the drop-down menu. There will be a provision to provide what would be the reason that it was not met. There will also be the provision at the end of each individual's row that identifies its goals and whether they were met or not met with reasons. Ability for service providers, should they choose, and largely for their own purposes, to provide some comments about that whole exploration of that individual, their goals, and their goal attainment. And what we believe is that we're hoping that because service providers are already in the process of using individual service plans, the idea of aligning goals with outcomes, that this simple spreadsheet is going to assist them in tracking for their own purposes attainment of goals at the individual level across the various domains, attainment of goals across all individuals at the various domains, and where goals were not met, a running tally, sort of again a pre-populated tally, a frequency sheet of where goals were not met, what were some of the predominant reasons why they were not met. Again, is that from a regional perspective, you will not be submitting individual results, rather just what are the agency results for that specific quarter. I also want to clarify that when it comes to reporting on a quarterly basis, that you would only be reporting on those individuals who you had an ISP review with during that quarter. So only one individual should only be reported on over the course of one contract year. Of course, as new individuals come in, you can add them. From a go-forward perspective, what we're going to be suggesting is when you see the template, that you only populate those individuals that you are meeting with throughout that quarter. There is no need to pre-populate the reporting template with all of the individuals you serve. Have all of their goals input at the onset. Do that as the term progresses, and by the year of end one, you'll have a fully populated spreadsheet that can then be built on for years 2 and 3. And again, for the purposes of this module, it's going to be too difficult for us to show you the spreadsheet. Service providers, by the time you're able to view this, either shortly afterwards will have access to that spreadsheet. And we hope that along with this particular module, that you'll see how it's going to work. In addition to setting the establishment of goals at the individual level, Section C also talks about quality of services, and that agencies will choose to one or more areas that they wish to improve on over the course of the term of the agreement that aligns with this particular domain of quality of services, or a pillar of quality of services. And you can see there are 3 domain areas: relevancy, effectiveness, and efficiency, with little descriptors besides each of those. The PDD Provincial Contract Advisory Committee, again in consultation with service providers, suggested that what we also do is provide that opportunity for agencies to highlight one or more areas where they want to invest in their organization that they believe is going to benefit their staff, the people that they're supporting, and the community at large. There can be any number of areas that they may wish to develop in. I believe we've highlighted training, investing in training as one of them. And the intent is to identify the goal, because you're going to set a goal as an example around training because you want to see a particular benefit, see a particular change in behavior at the agency level, or see a particular change in the result of outcomes for the individuals you support. All that will be needed is a simple descriptor of what it is the activity that you're going to be undertaking. And then, much like the individuals, if there is the ability to report on a quarterly basis as to what you've done and what you're achieving, we'll be asking for that. But we also acknowledge that there are some of the goals that you're going to set, you may implement in quarter 1, but will not see the results until quarter 4. In that case, you would be submitting the results of what were the achievements you had relative to that goal. Did you meet it? Did you not meet it? And if you did not meet it, what were some of the rationale? I must also acknowledge that while our initial attempt is focusing largely on not met, we acknowledge that we have to pay a lot of attention to why we're meeting goals, either at the individual or agency level. We believe that we can learn as much, if not more, about the positive outcomes that we're able to achieve and how that might impact us as an organization and the individuals that we support, as much as we can improve from understanding where we need to do better. And again, the reporting template will have a tab that is very specific to the quality of services, and it will be largely more narrative than a pre-populate or a spreadsheet that has the ability to pre-populate. What we're really wanting people to do in this particular area is to reflect and describe what it is that they're doing from a learning perspective more than from an sort of a tallying perspective. Within this document, you can see there's a number of points that the Provincial Contract Advisory Committee wanted to highlight. And again, what we can see is that we want to reiterate that this was a collaborative approach between PDD service providers and staff. And that what we're hoping to do by the use of a standardized reporting template that uses quality of life domains and pillars, that we're going to be able to roll that information up at the aggregate level and to get a clear sense about if we are really all about achieving outcomes, how are we achieving that? What are the results that we are looking at? Where are the areas of focus around those pillars and domains? And what can we learn from all of that? Again, by using the ISPs, we hope that this is going to streamline not only the overall process, but the reporting of them. And the reporting template which you have will also be able to benefit you directly in the services that you're providing. And again, at the bottom there, really, because we're all about outcomes and achieving a good life for people, we believe that continuing to use the quality of life indicators and that particular framework is the best way to proceed going forward. And again, on this slide, we talk about we'll use the good work that's already being done at the ISP level as a mechanism for both identifying, measuring, and reporting. And that will ensure that we're not introducing new or additional work around all of this, around the outcome reporting. We also acknowledge there is that we'll need to continue to support both our staff and service provider staff in utilizing this new process and new tool. And so stay tuned for more news on the possibility of a future webinar to pay attention to this specific area of the contract template.
So as previously mentioned, the initiating activities, given that we now are operating under the construct of our pre-qualified resource lists with qualified service providers, the first step in that process is that service delivery regions will send out service requests to incumbent contractors delivering PDD services. So if you have currently a contract with PDD to deliver direct services to clients, you will be receiving in the next few weeks a service request from your service delivery region. Again, that's a fairly basic form that outlines the services desired or required, as well as the estimated contract budget. So you'll see that in this service request, one slight difference is that there are now two separate lines outlining the estimated contract budget. The first includes the allocation for direct service costs, and the second line will include an estimated lump sum allocation for indirect services and ancillary program costs. So knowing that each region uses a different process in determining what that lump sum allocation is, we've set it up as an estimate, and we'd suggest that the best time to have specific discussions around the amount is when you actually receive your first draft of the contract. So again, you should expect in the next few weeks that initial service request. That's an opportunity for you as a service provider to review it, ensure that you agree with the services outlined and the estimated contract budget. You would then sign it, return it to your service delivery region, and that would trigger the process for regions to start preparing those agency-specific agreements or contracts. As we mentioned, when you receive that contract, it will have included in it, either within the appendices to the schedules itself or as a separate reference package, those electronic reporting tools, as well as the links to the standards and policies and other requirements that normally form part of your contract. So we would suggest things for you to start thinking about now that I hope you have the benefit of some more information and clarity from this session, is that you would consider the process for criminal record checks. So this would be a good opportunity to check your employee files, make sure that you have criminal record checks on file, or the results of those checks on file. If they're nearing or have passed that 3-year mark, then that should signal a requirement to, again, initiate an additional criminal record check. This is also a good time to start thinking about Schedule A. As we mentioned, there are a few areas in Schedule A that in exceptional circumstances may include key positions and or deliverables and intellectual property. Again, that's a conversation for the contractor and the service delivery region to have, to consider whether there are portions that need to be included within the Schedule A. Back to our conversation about subcontracting and assignment of work, I would suggest that you'll see within Schedule A, in the contractor portions, a reminder to please indicate your intent to subcontract, if any. And again, this is not a requirement to list your subcontractors by name or agency, but rather just to broadly identify whether you intend over the course of the contract term to subcontract a portion or all services within that service category. The next step from a regional perspective is really to start developing Schedule B. So if there are advance payments to be considered, the primary focus and the primary focus of discussion between the service delivery region and the contractor is going to be that transition from the old to new Schedule B, and how budget allocation in 2016 now gets allocated out to those new funding categories in your 2017 template. As Tim mentioned, Category 1, direct service costs, will be set by the region. You will then have a lump sum allocation for indirect services and ancillary program costs that it's up to you as the service provider to allocate based on where you anticipate those expenditures and those pressures to fall during the contract term. Again, you have some flexibility to reallocate with some parameters, but good things to start thinking about now. And similarly, review those eligible and ineligible expenditures so that you can have a good sense of what areas within there that are considered permissible uses of those public funds, how you might want to allocate within those categories. Tim has referenced the Provincial Contract Advisory Committee, or PCAC. So the role of that group really continues. It's an important forum for service providers and the province to together discuss issues of mutual concern. We know that we are rolling out a new contract template and that there will likely be some conversation through the coming years, particularly in this contract term, about how provisions within the contract are being applied. So as I mentioned, our focus here will now turn towards supporting regional and provincial consistency in how those provisions are applied, defining some common, clear processes and policies to help support the rollout of the new contract template. But the PCAC is certainly a forum to bring some of those concerns forward if that indeed is the case. So if we identify with PCAC over the coming year or more that there is consistently an issue with how a particular provision is being applied or interpreted or practiced, that would be the place to have that conversation and to determine how that might be addressed, whether it's through a revision to the contract clause itself or through some focused or targeted training with service delivery staff and or service providers. If you have questions, please refer to that questions and answers document. As I mentioned, we will be updating that fairly substantially to reflect questions that we've received through these sessions. We're hoping to have that posted towards, I'm going to say next week, but for those that are viewing these at a later date, that's not particularly helpful. So I would say by the 10th of February, we would hope to have those posted. If you have additional questions that are not answered in that document, please contact your regional contract specialist. If they're not able to provide the information to address that question, they will escalate it and we'll get an answer posted again to that Q&A document. Your PCAC representative for your region is also a good resource to go to with questions or for information, so we'd encourage you to do that as well. So we've outlined in terms of next steps what that process looks like for submitting additional questions. Today is the final regional session. I'm happy to say that we have successfully wrapped up our whirlwind tour across the regions. We hope to record and post this session by February 3rd. And then again, our focus turns to practice and rollout and support to get the new contract signed for April 1st. So thank you very much for joining us. Thank you for your good dialogue, and take care.